Chris and I are going to be talking about nonprofit collaboration, mergers, and affiliations. We're glad to be here to talk to you today. So just as an introduction, my name's Josh England. I'm a tax strategist with extensive expertise advising high net worth individuals, nonprofits, business owners, and investors on effective strategies to ensure tax efficiency, asset protection, succession plans, wealth preservation. I also work extensively with charitable organizations, assisting them to incorporate, obtain tax-exempt status, advising them on issues such as unrelated business income tax, corporate governance, and planned giving. With that, I will say my colleague Chris has really stepped into the nonprofit section and sector and does a lot of the advising for our nonprofits these days. Chris, do you want to introduce yourself?
Thanks, Josh. Very complimentary. So as Josh said, my name is Chris Consoletti. I'm a tax consulting attorney here at AAFCPAs. I focus mostly on nonprofit organizations and specialize in anything from private foundations, nonprofit formation, dissolutions, as Josh mentioned, unrelated business income rules, lobbying, which is coming up a lot more recently, and multi-state charitable solicitation analysis. You know, any issues nonprofits have, I like to specialize in. So that being said, why should you care about our topic for this presentation? So, I mean, why would your organization want to explore collaborations or affiliations? So there's at least 4 reasons we'll talk about in this program today. Financial considerations, certainly first and foremost. You could address with a collaboration, affiliation, a merger. You could address future or current financial crises. You could develop more cost efficiencies. There's also program benefits. You could expand the program reach. You can increase your service provisions, you know, with 2 combined organizations. There's certainly advocacy benefits. With collaboration, you can reach a wider audience with the strength of 2 organizations together as opposed to 1. Certainly there's leadership benefits to combining organizations. You combine the employees, you know, the staff, you know, different perspectives. You can also strengthen your brand in an area because you're combining, you know, the marketing teams in each organization. So there's a lot of reasons outside of financial considerations that organizations might want to look into what, you know, our topic today that might help them. So that having been said, we're going to launch the first poll. So has your organization considered any type of collaboration with another organization?
So while the poll is underway here, I'd just like to say that, you know, there are many ways to collaborate, and collaborations aren't mutually exclusive. Organizations can and do collaborate with multiple organizations, often from multiple sectors on a wide range of initiatives. In fact, more than ever, organizations must collaborate both broadly and deeply, because that it will take the address and it will allow them to address the complex challenges that we face.
Right.
So moving on to the next slide. What we provided here with is a collaborative map with a nice infographic from lapiana.org, which is intended to show the different levels of collaboration that a nonprofit may undertake. We've got the outer green ring, which is a basic collaboration where 2 organizations may just come together in an informal agreement. The inner circle, the blue ring, may be an alliance, which needs a more formal, structured partnership. You may want to consider such options as shown in this inner blue ring, which really falls into 2 broad categories. Those that involve doing some part of your nuts and bolts business together, such as programming, administration, revenue generation, and those that are really more about working together to have an impact on the field. And then the final inner ring, or the bullseye, is more of a restructuring, which could result in a merger or a joint venture. But it's 2 or more organizations seeking to come together in pursuit of that shared goal, and it might result in a structural change or the creation of a new entity. So as we think about collaborations, And we've seen a movement toward collaborations and linkages of many kinds among nonprofits to combat that growing need for services with fewer resources. There's no denying the importance of collaborations for many organizations, and particularly in tackling larger social problems. Leaders of nonprofits have to be aware of the different legal structures that may be possible before entering into these collaborations, and we're going to go through some of those here. So the first one here is just an informal understanding, what may be called a memorandum of understanding. And the key here is that it's not an enforceable agreement where either party has any legal responsibility to comply with the terms. And you want to make sure that if you're entering into these memorandum of understanding, that you're not creating an enforceable agreement. Organizations must be very careful about drafting these MOUs if they don't want it to be legally binding. It can easily turn into a contract by virtue of the words used in the document, and it can cause confusion between the parties that have entered into the agreement. Whereas if you do want something that is more binding, that's when you're talking about maybe an affiliation agreement or an actual contract between the parties. And that contract is going to outline the terms and condition of the affiliation between the two entities. It establishes a relationship where each party works towards a shared goal, perhaps related to fundraising, event management, or public outreach. These agreements can vary widely depending on the specific relationship that you're trying to create, but they generally include details about the obligations and rights of each parties, the scope and limitations of the relationship, and the terms of agreement and termination, ultimately. So, a well-drafted agreement can ensure that both parties' interests are protected while making sure that the mutual expectations are being met. So when we're talking about a service agreement, that's a more simple form of collaboration in which one party provides services to another party in exchange for money or some form of consideration. For example, a research firm might provide its research services to a service provider in a way that benefits both parties and furthers their respective missions. The research firm gets paid and they have valuable applications that they would otherwise not be designed to pursue. And then the resource sharing agreement, you were going to talk about that, Chris.
Yes, just because it's something I've seen with a lot of clients. I'm sure most people on this call, a big issue with the organization is staffing shortages. Or office space, because with most people working from home, you don't need as much office space you did before. It's really useful for nonprofits to combine, certainly office space, share one building between two organizations, maybe more organizations, certainly share equipment if that's applicable, and certainly sharing employees. Resource sharing employees is very useful so you don't have excess employees, you don't have too little employees, to combine them to work on each organization. Obviously, each nonprofit needs to pay the employee for the specific work they do, but it's very useful for nonprofits if they don't want to do any formal agreements. Resource sharing is a good way to alleviate the staffing shortages that I'm sure everyone faces. So moving on to other types of alliances, I'm going to start talking about fiscal sponsorship, something that comes up a lot. At its base level, it's a way for the sponsor to bring in additional revenue. And then at its core, it's when fiscal sponsorship is when the sponsor lends its nonprofit status to another organization that might not have its own individual nonprofit status, so it can't accept donations. This could be another organization. It could be a startup nonprofit that hasn't got its tax-exempt status yet. It could be just an association. So there's different reasons why you might want to consider a fiscal sponsorship. One is certainly to get fees in, to do your programs. Another way is to collaborate with another organization that you might be able to use their resources for. And, just to explain fiscal sponsorship, there's a bunch of different types of fiscal sponsorships. The most common ones are the Model A type, which is essentially a direct project where the sponsor the entire project exists in the sponsor. There's no separate legal entity for the sponsoree. So the sponsoring organization, they take in the donations, they do the project, they do the back office work, they administer the entire thing, and it lives in their organization. So there's no separate entity. So this is most likely when there's just a group of individuals that want to do nonprofit work. They don't have their own organization. They partner with a 501c3 that can accept donations. The whole project exists in the 501c3. Then there's the Model C type of fiscal sponsorship, where there's two separate legal entities, whether it be two separate nonprofits, a for-profit and nonprofit, but there's two separate organizations. It's really more of a grantor-grantee relationship between the sponsor and the project, whereas the sponsor must maintain, they take in the contributions because they're the 501c3, they send the money back to the other party. That's essentially their responsibility, is just to make sure to oversee the grants, make sure that they're used for the fiscal sponsorship's purpose. The sponsoree is required to do everything else. So it's a way for the sponsor to take money in. They don't have to do a ton. They just take the grants in, send them out. But they can also collaborate with another organization. They can help a small nonprofit that maybe isn't set up yet. So they can give back, they can make money, and they can, collaborate with another organization. So having said that, I'll throw it back to Josh for the partnerships and joint ventures.
Sure. So, thanks, Chris. A partnership is really where you've got two nonprofits who want to enter into more of a deeper collaboration on perhaps one particular program. And what they might do is form a third entity, either a limited liability company, or maybe even another nonprofit, or a partnership in and of itself to undertake that program. It's each party is now jointly and severally liable for the undertaking of that, and it's more of a formalized undertaking through using a separate entity. Whereas a joint venture, we often see those when we're dealing with collaboration with a for-profit entity. And nonprofits may want to enter into joint ventures with for-profits to raise capital, to access expertise possessed by these for-profits, to take advantage of opportunities that otherwise might not be available to them. For-profits may want to enter into these joint ventures to, again, access new sources of capitals, grants, and the like, to exploit specific assets owned by the nonprofit, maybe intellectual property or something along those lines, or to take advantage of some of the available tax credits, such as low-income housing tax credits. And finally, to acquire greater community or political support. But when a nonprofit is engaging with a for-profit, you have to be careful. For one thing, if that for-profit joint venture is creating a lot of income, which is great, we all want that income, but there's a issue that if that collaboration is not substantially related to the nonprofit's exempt status, that it could be subject to UBIT, and if a substantial part of their income is resulting from UBIT, it could jeopardize their 501c3 status. So you need to think about how to set up that for-profit joint venture, whether it be a corporation or an LLC. There's also control issues. The nonprofit must retain control of the charitable activities of the joint venture, and it's got to have the right to appoint at least half of the board in one of these corporate joint venture entities. So, both of these are great opportunities to collaborate with other organizations and come together in a way that allows them to join and benefit each other. So finally, that inner circle, that restructuring, the merger we're going to get to in a minute. We've talked about joint ventures. Those can be much more complex and involve a lot more activities between the two entities. And then finally, a parent subsidiary. We're actually going to cover that again later on in the slides.
Thanks, Josh. So what I want to talk about is affiliated 501c3s and C4s. Your question might be, why would the C3 want to set up another affiliated tax exempt organization? So there's one main reason. So just to spell it out, 501c3s can accept deductible charitable contributions, but they have a lot of restrictions on what they can do. So an individual can give to a 501c3, take a tax deduction. A 501c4 can do a lot more with their funds, but their contributions in are not tax deductible. So people aren't likely to donate to a 501c4 because they can't get a tax deduction. So why would a C3 want to set up a C4? So most often they'd want to set up an affiliated C4 during a long-term lobbying campaign. So a C4 can conduct unlimited lobbying, where a C3 has a lot of restrictions on lobbying. They can only do a certain amount. They have money restrictions, record keeping. And if they do too much, they could lose their tax exempt status. So often a C3, if they're going to do a lot of lobbying, they will set up an affiliated C4. Affiliate doesn't mean the same. It's a separate legal entity, separate 990 filing, separate EIN, separate bank accounts, unique board members, separate and distinct bylaws, different articles of organizations. It's a separate organization. They can't share funds. The funds must be separate, so the IRS doesn't aggregate everything together. It defeats the purpose of setting up an affiliate organization. Now they can certainly share staff and office space, but you have to be very clear that the staff are being paid for C3 activities, and then for the C4 activities, you can't just send them one check. It's separate organizations, separate payrolls. So
Chris, I would just add, the reason, a C4 can undertake lobbying, but it can't engage in any campaign activities, right? It can't make endorsements. It can't make contributions or expenditure for certain political candidates or a particular cause. There's no communications that support candidates or parties. It really has to be an unbiased educational activity by the 501c3, whereas a C4 doesn't have any of those restrictions. They can contribute directly to candidates. They can support candidates. They can support a particular political position.
Correct. That's why when you see these organizations, the money doesn't go from the C3 to the C4. It goes, if they want to move the money, it goes from the C4 to the C3, because the C3 doesn't have the restrictions on the money. It can be used for, if the C4 sends money to C3, it can be used for their exempt purpose. They don't need to follow those rules that Josh just mentioned. So that's how you move the money back and forth between an affiliate and organization. Obviously, grant agreements are always a good idea. Documentation's good in case there's ever an issue, but there's obviously less restrictions on this type when you send the money. So now we're going to start to talk about mergers.
I would say the classic example of a C3 and C4 type relationship is the Sierra Club. The Sierra Club has their own C4, which they use to support their environmental mission and support environmentally friendly candidates. And then they have their C3, to which people can make tax deductible donations, which engages in their educational activities.
Sorry, cut you off. So now we're going to start to talk about mergers. These are formal restructurings between two organizations. So this is essentially the last step if you decided that your organizations need to formally combine. So why would you consider a merger? Well, possible solution to a financial crisis. It's better to merge into another organization than dissolve and lose all your staff. Can certainly improve the cash flow from two of the organizations you're combining assets. It's another way to avail yourself to new funding sources, new donors, new space in the industry, new territories to bring in funds. It can certainly help eliminate the competition if two organizations are merging in the same space. Now, we think about competition sometimes in a negative way, but in the nonprofit space, it's access to new donors. New donors means new funds. New funds means you're able to do more of your exempt mission, help more people. So formally combining two organizations, it'll eliminate two separate organizations going for the same donors, more funds into the organization, more greater reach for your programs.
So, Chris, I think, as you said, a merger is sometimes referred to as the ultimate collaboration between two parties. And typically, in a typical merger, the corporation that remains in existence is referred to as the surviving corporation, whereas the corporation that is merged out of separate legal existence is referred to as the disappearing corporation. And mergers are complex transactions that generally require negotiation over matters such as the addition of board members from the disappearing corporation to the surviving corporation, preservation of certain programs previously run by the disappearing corporations, and decisions on which, if any, employees of the disappearing corporation will continue as employees of the surviving corporation. But there's still a lot of benefits to that. As you said, there's cost savings by overlapping administration and program services into one organization. Increased resources can eliminate the need for two spaces. There are programmatic efficiencies and effectiveness. And as you said before as well, there's the ability to reach out to new funders and donors that may not have otherwise been available.
And just another thing to consider for mergers is, we won't touch on this for a while, but one organization is dissolving in the merger. So one is surviving, one is dissolving. So if this is something you're thinking about, you just have to realize that your organization is essentially going away in favor of the organization that you're merging into. So, goodwill, anything that you have built up will essentially go away. And as mentioned above, these are expensive. Mergers are expensive. Lawyers are expensive. Legal costs can add up quickly when you're even looking into doing a merger. Due diligence is a lot of work. You have to have a lawyer review all the other organizations' documents, their federal and state returns, their finances, their staff, their leaders. If this is what your organization is considering, it'll take a couple of years before you realize the cost savings from a merger. And as I mentioned before, one organization is terminating. So when the merged organization, they file a final 990, they mark final return. The EIN is shut off with the IRS. They're essentially dissolved when they merge into another organization. I think that we're going to launch the second poll. And our question is, does your organization have any affiliates or wholly owned subsidiaries?
So with that, Chris, I would just say when you're thinking about a merger, as I think you mentioned, for cost savings, don't expect that at the outset that the cost savings are going to override the cost of the merger. When you're talking about due diligence, preparation, integrating the activities, that can be very substantial.
So I think we'll just this poll. So I did see one question in here I wanted to make sure I got to it, about what are the best practices to handle when a collaboration ends and the sponsored agency is now recognized as a C3 and the assets need to be moved. So assuming this is a fiscal sponsorship, it can continue if it wants to, but the best practice would be the sponsor to just grant the money back to the organization, based on the terms of the agreement, of course. But you can certainly grant money to another 501c3 and there's no tax implications. So if that's the issue, that's probably the best practice. Or you can continue the fiscal sponsorship with two separate C3s. That's certainly allowable as well.
Great. So, we mentioned that there might be other affiliated structures that a nonprofit might have as part of its overall entity structure. One of those being a single member LLC. Chris, why would a nonprofit want to have a single member LLC?
Sure. As simple as terms, liability. A single member LLC is not a separate tax-paying entity, but so all its activity is reported on the parent 990. But if operated correctly, a single member LLC can own a real estate, like a real estate property, a separate project. And if operated correctly, the structure provides the parent nonprofit liability protection from what happens in the LLC. So as long as you observe separate bank accounts, everything is separate. If someone were to get hurt at the building owned by the LLC, the only assets at risk for the lawsuit would be the LLC assets, not the parent nonprofit. And as a single member LLC that's wholly owned by the nonprofit, most states allow it to receive the benefit of the parent's tax-exempt status for real estate, property taxes. Not every state handles it this way, but that's how Massachusetts does. And now, Josh, why would a nonprofit want to set up a separate tax-paying C corp? What's the benefits of that?
So usually that's because of UBIT-related issues, the unrelated business income tax. As I mentioned before, if a nonprofit has substantial unrelated business income tax, it can put its 501c3 status at risk. And so the idea would be to take those UBIT activities, wrap them up inside a C corp, which is wholly owned by the nonprofit, and recognize the income inside the C corp. And then to the extent that there are profits, that C corp can then dividend those profits out to the wholly owned nonprofit. Those dividends aren't subject to UBIT because they're considered passive income. The activities inside the C corp are subject to tax at the 21% corporate rate, which is essentially the same rate that that the nonprofit would be paying on a 990T. There's also the benefit that when you're talking about a C corp today on a 990T, you have to silo all of those separate UBIT activities, so that if you have a loss from one UBIT activity, you can't apply it to gains from another UBIT activities. Whereas if they're all inside a C corp, those losses can be aggregated. And so with that, we don't have a lot of time for questions, and so we'll address and reach out to those that have asked questions in the Q&A here. But we would just close with the often heard expression, trust but verify. The same wisdom applies to collaborations. Verify exercising reasonable care in the process, that your collaborator is trustworthy, capable of pursuing your common goals, and meeting all of the obligations that you've undertaken to perform. And you want to protect yourself to a reasonable extent as possible.